on the microeconomics of investing. I have explained you how to find for excellent businesses. This is businesses with a large, high return on capital employed, which is sustainable because it has some kind of competitive advantage. But although more or less it was implicit in what I was saying, I want to make it explicit in order not to lead you to a confusion. You don't have to buy only excellent businesses. You have to buy excellent businesses at a bargain price. Okay? So once you have estimated some kind of intrinsic value, you have to compare that intrinsic value with the price of the market. I mean, we can say Coca-Cola is an excellent business because it has a huge moat and an increasing profit rate. Okay, but if all those influences are already taken into account in the market price, you shouldn't invest in Coca-Cola. Okay. The fact that a business is excellent don't prevent you to overpay the price of that business. So you have to buy excellent businesses at good prices. Luckily, Mr. Market, which is a metaphor which employs the first value investor, Benjamin Graham, offers you from time to time good business or good purchasing opportunities. Graham said that Mr. Market was like a guy who was selling you companies at a lot of fluctuating prices. So one day he's crazy and he asks you a huge price for a company, next day he's crazy and asks you for a very low price for that company. So you have to wait up to the moment that Mr. Market offers you good purchasing opportunities, good investing opportunities, and buy it. Okay? But focus to buy not bad businesses at good prices, which is another kind of investing. I mean, Benjamin Graham wanted to buy any kind of investment which was selling at bargain prices. So even if the business was very, very bad, if it was being sold at an enough discount, he was willing to buy it. But Warren Buffett, which learned with Graham, said, as there will be many business opportunities, focus on buying just those which are selling at bargain prices, but where the underlying business is excellent. Okay? Not be cheap is not the reason to buy something. It's being cheap plus being an excellent business. Okay? Well, now let's go to the second part, which is the macroeconomics of investing. I won't go into much detail on the business cycle theory. If you are interested, we can discuss it in the question part, because I think traditional Austrian business cycle theory is very strong, but should be corrected in some instances, or should be turned more realistic in some instances. But we can discuss, if you want, those points in the question turn. Just say that business cycle is characterized by a general erosion in the liquidity of the agents. You can erode your liquidity by investing in long-term risky assets, or by financing yourself with short-term debt. Okay? Business cycle comes from a general and non-sustainable erosion of the liquidity of the agents, which is used in order to malinvest, to commit investments which are not well directed. The cycle then is characterized by an increase. The boom phase is characterized by affected by an increase in investment, especially in very long-term industries, very far away industries which are far away from consumption, and by an increase in liabilities, by an increase in credit. So it's a credit boom which is not sustainable and which focus the credit on very capital-intensive industries. These are precisely the kind of industries that will be more affected by the cycle. Although all the economy is affected, some industries will be more affected than others. The kind of industries that will be affected are those more capital-intensive. And which are the industries more capital-intensive? For instance, the housing industry, where you buy a very long-term asset, a very durable consumer good, and also capital goods industries, which are very far away from consumption. So here we have to answer two kinds of questions. The first is how to value cyclical industries. This is industries which are especially affected by the cycle. And then how to value the general market, because we should not forget that we are buying specific companies, but companies which are inside a context, a general context of the market. So although the company may be excellent and may be selling at bargain prices, if the whole market collapses, at least in the short run, the price of your company will collapse, which is not something negative, or well, it's negative, but it's not something you must be completely afraid of, because as we have explained, that's not risk, or we shouldn't see risk as the falling of prices. Okay, if the price will recover in the future, you haven't had any definite capital loss. But of course, if you can anticipate a general collapse in prices, you can maximize your profits, because if you are buying an excellent company just after the general price of the market has collapsed, you buy excellent companies at a huge discount. Okay, so we have to take into account both possibilities. Okay, the problem with cyclical industries are durable consumer goods industries. This is, well, in general, which are the industries which are more cyclical and then more affected by the cycle? Those industries which some way or another depend on credit. Okay, the business cycle is a credit phenomena, so there will be some industries that, for instance, most of their production is sold on credit. Then those industries will be more sensitive to the cycle. Housing industries is a clear example. Almost all houses are sold against a mortgage. So if credit is more expansive, if more people are asking for mortgages, there will be a higher demand for houses. So the housing industry will sell more units of the product. If on the contrary, credit is very restrictive and no one can ask or can get a mortgage, the sales of the housing industry will be very reduced. So there are industries which are very sensitive to the level of credit. Others are more or less insensitive. The restaurants industries, of course, are affected by the cycle, because if there's a general crisis, every industry is affected by the cycle. But it's not very much affected because there's not enough credit. Okay? So, the point is not there are industries that during the boom phase grow at 5% and during the recession phase fall at 5%. This is non-cyclical industries. And then you have industries that during the boom years grow at 90% and during the recession years fall at 70%. Okay, that's the kind of cyclical industries we are thinking of. Not industries that are worse off in recession, because that's a general phenomenon, but industries that are proportionally very worse off during the recession, or which are proportionally very better off during the boom years. Okay. Restaurants were not selling much more because of people getting indebted. Of course, the revenues increased, but not over proportionally. Housing industries, or every industry which is financing himself on credit, obviously increase its revenue or its investment because of cheap credit. Okay. Well, the problem of valuing cyclical companies during the recession years is that, as we have said, we valued companies through the price-earning ratio, okay, through the profits of the company. But what happens when the company either don't have profits, in which case you don't have a price-earning ratio, or has very tiny profits? Imagine that a company which is worth 10,000 euros has this year just some profits of 100. Okay, the price-earning ratio of that company becomes 100. So you may think this is not a good investment, because a company which has a price-earning ratio of 100, we have said that the normal price-earning ratio is 15. We should forget about investing in this company. But if we did that kind of analysis, we would be losing good businesses, good investing opportunities. Okay, so for investing in very cyclical industries, this is industries whose profits are very fluctuating, we need to look for another method, which is somewhat more sophisticated than using the price-earning ratio. And the way of doing that is through the price-sales ratio or price-revenue ratio. We have defined the price-earning ratio as the market value, the capitalization, the market value of the company divided by the profits of the company. Okay? But we can decompose the profits as revenues or sales times the margin of every sale. Okay, imagine I have a profit of 1,000. That can be because I sell, or my revenues are 10,000 euros, and for every sale I gain a 10% of its price. This is my margin over sales is 10%. Or it can be because I sell, my sales are 100,000 euros and my margin is just 1% on every sale. So there are many combinations. Okay, profits is revenues times the margin of the company. There are companies whose margin is larger, and there are companies whose margin is much narrower. For instance, supermarkets have a very narrow margin of profits for every product that they sell, but they sell so much that although the margin is tiny for every product, the total profits are important. Okay, so we can decompose profits in sales and margins. So we can do that also in the price-earning ratio. If we name this ratio between capitalization, market value of the firm, divided by sales or by revenue, the price-sales ratio, we can well, that would be 1 divided by the margin. Okay, but we can decompose the price-earning ratio into two parts. This is to correct this. We can decompose the price-earning ratio in two parts, okay? The price-sales ratio and 1 divided by the margin. Why this is useful to us? Because in cyclical companies it makes more sense to look at the price-sales ratio than at the price-earning ratio in order to value the companies. For instance, imagine we have a company with sales or with revenues of 10,000 euros and a margin of 10%. So profits are 1,000. If the price-earning ratio is 15, the market value of the company would be 15,000 euros. Okay? But now assume that at period 2, the margin falls from 10% to 0.1%. So, even if the capitalization, the market value of the company falls to 1,000, the price-earning ratio would be 100. So you would be saying, I don't want to invest in that company because it makes no sense to invest in a company with a price-earning ratio of 100. But if you look at the price-sales ratio, this is what price I am paying for buying the sales, the revenues of the company. You would be paying you would be paying just 10% on the sales, okay? If you divide the market value of the company, which is 1,000, divided by 10,000, you would end up with a 10%. This is, you are buying every dollar of revenues of the company just by 10 cents, by paying 10 cents, okay? I repeat. This company is selling every year 10,000 euros, so have some revenues of 10,000 euros. You can buy this amount of sales, of revenues, just by paying 1,000 euros. So you are buying the revenues of that firm at a discount of 90%. The problem which is in period 2, that the company is obtaining very tiny margin for those sales. So it's not, at that moment it's not a bargain. You are buying, okay, very cheaply your revenues, but your revenues are not transformed into profits, or are almost no transform into profits. But if you think that the margin will increase in the future, this is, the margin will remain always at 0.1%. Probably not, because that's a cyclical industry, so we are at a time where the industry is experiencing difficulties. So if you assume that in the future the margin will increase, maybe at an intermediate level, not 10%, which is the boom phase, not 0.1%, or even negative margin, which is the recession phase, but at 5%, what would happen? You would have a 5% margin over your sales, so you would have some profits of 500 euros, and if the price earning ratio comes back to 15, which is, as we have seen, the historical average, the company would be worth 7,500 euros. So you would be able to multiply your initial investment by a 7.5 multiple. Okay? So, in the case of the price sales ratio, it makes sense, in the case of cyclical companies, it makes sense to try to know whether the company is cheap or expensive, not by looking at the price earning ratio, but by looking at the price sales ratio. The price earning ratio is just a measure of how cheap are you buying the profits. I am paying that quantity of money for that quantity of profits. This is, if I pay $15 by $1 of profits, I am paying 15 times $1 of profits. This is a price earning ratio of 15. I buy now all the future stream of profits by paying 15 times the current amount of profits. The price sales ratio measures which price I am paying for buying $1 of revenues in the company. In this case, in period 2, I was paying just 10% of every dollar the company was selling. So I was buying the sales at a huge discount. The point is, if this company is able in the future to restore his margin of profits, as I have bought the sales very, very cheap, I will obtain very, very cheap profits. Okay? So this is the way to value cyclical industries. By looking at the discount you are able to buy the revenues of that company. The investor who developed the price sales ratio, which is Kenneth Fisher, suggested you to not to buy sales more than at a price of more than 75% of its price. Okay, so the price sales ratio should never be higher than 0.75%. If you pay more for sales than 0.75%, according to Fisher, you are overpaying your company. It would be very difficult you to obtain profits from that investment unless that company increases its profitability in the future a lot. So one way of protecting you from overpaying is not investing in businesses with a price sales ratio higher than 0.75%. And if you are able to buy companies, for instance, at a 0.1% of revenues, sorry, at a 10% of revenues, this is with a price sales ratio of 0.1%. In case the company is not going to disappear, this is not bankrupt and it's losing all its value, it's very probable that you would experience profits in the future. Because just by increasing a little bit the margin, as you have bought the sales so cheap, you will have bought also the profits very cheap. Okay? Okay. That was the case just for cyclical companies. But now we have to study which are the effects of the business cycle in general over the whole market. So, the boom phase of the cycle is a phase of optimism. It's a phase of bubbles, of overpaying for the businesses. Because expectations are very high, they are there's a feedback of expectations every time we think things will get better, so we are willing to overpay. So the price-earning ratio of the stocks will be very, very high. In Japan, for instance, in the bubble of the beginning of the 90s, the price-earning ratio, the average of the market was around 80. The historical average for the last 2 centuries in the United States and in many other markets is 15. So, if you are paying 80, a price-earning ratio of 80, it's because you expect that future profits are increasing very, 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 very fast. Of course, that was not realistic in the case of Japan, and for that reason, the stock market, the Nikkei, hasn't recovered at all the level it achieved at the beginning of the 90s. At the beginning of the 90s, it reached 40,000 points, now it's 15,000. After 20 years, and after the Abenomics that have increased the stock market at 50%. So, 2 years ago, it was 10,000 points. And it reached, at the beginning of the 90s, 40,000. Okay? So, of course, overpaying for the businesses is very, very, very dangerous, because you can have definite capital losses. That's the kind of risk we want to hedge against. But during the depression, it's all the contrary. All the people think the world is going to end, that the companies are going to disappear. So, in general, people is underpaying, and it's selling for bad prices their companies. So it's a very good moment to invest if you can pick up companies which are going to survive. And I want you to think on the valuations during the depression in a particular way. You have 2 possibilities of valuing a company. One is the possibility we have been studying in the previous lessons. This is, the company will survive and you will have future profits. So, how do I value the company? Assuming it will have future profits and discounting to the present those future profits. That's viewing the company as an ongoing concern, something that is living and will continue to live. Okay? But there's another possibility, which is to consider that the company is dead, and that the only thing that can happen with that company is to be liquidated. So, in that case, how do I value the company? By its liquidative value, by the price I hope to obtain through the forced sale of its assets. I don't care whether the company will have profits in the future. I think the company won't have profits in the future. So what I am caring is, at what price can I sell this building? At what price can I sell this machine? At what price can I sell this stock of commodities that the company has on its assets? Of course, the liquidative value of any company is much lower than the price of the company as an ongoing concern. Why? Because the value of the company depends on the synergies of the company, on the capacity that all the structure of the assets of the company have in order to generate future profits. If you divide those structures into pieces and sell those pieces to many separate investors, the individual profitability of every asset is almost worthless. It's almost scrap value. I don't know, but imagine you want to sell a railway company by pieces. Obviously, the price of a railway is not very high. Its value, the railway has value because it's inside and structure of the company. Okay? So, companies can be valued as if they are going to be liquidated. This is not very common. In fact, it's something quite rare and quite strange, but it can happen. And the moments when it happened, when it happens, are the best moments to invest. Why? Because the price-earning ratio, what happens? Goes from 15 to 1 or 2. Because you are not asking yourself how much profits will the company generate in the future. So you are not paying too much for the future profits, because there you don't care about future profits. You are just paying for the price you think you will obtain by selling at this moment in bad conditions the assets of the company. So what happens if the plenty majority of investors value all the companies as if they were going to be liquidated? You buy at those times a company which you expect won't be liquidated, because obviously in general not all companies of the market will be liquidated. If not, it would be the apocalypse. Okay? What would happen if you buy those companies at a liquidative value, and then the company is not liquidated, and in some years it's valued not at its liquidative value but as an ongoing concern? You can have monstrous amounts of profits. Okay? Why? Because imagine the pair of a company is 2, its profits are 100. So capital value 200. And then in some years the profits increase to 1,000, and the company is valued not as it was going to be liquidated, but as it is going to survive, and then you discount future profits, etc. And it goes, the price-earning ratio, to 15. Result, the company is worth 15,000 euros. You have valued by 200. You may think these figures are very unrealistic, but you could find this kind of investments not with lots of difficulties, but it was the common investment in 2009, for instance, because all the market was valued as if the companies were about to be liquidated. So bargain sales were the norm, were the most common thing in the market, because in 2009 every investor thought that the stock market would fall to its minimum, historical minimum, that the world economy was going to collapse, etc. So the expectations were very, very, very negative. And in those cases, those who thought, well, probably the world economy is not going to collapse, maybe we have some recession, but it's not the end of the history, etc. Companies will survive and will create wealth in the future. Those who thought like that and bought those companies at the cheap prices they were selling have obtained huge amounts of profits. Okay? I mean, if you look at the stock charts of many companies in 2009, you can see evolutions of falling a company at a price of 5 and then increasing at a price of 100, for instance. And this is because of this. The profits of the company maybe didn't change so much, but the point is companies were started to be valued as a liquidative thing, as a thing that should be liquidated or that was going to be liquidated. Okay? So it's interesting to know what's the general valuation of the market besides the particular situation of any stock. I mean, you have the first is for sure to select stocks that are good businesses and which are selling at a discount. But if apart from this you can buy those stocks at a good moment along the cycle, the better, because you are obtaining a double security. So how can we know if the market is cheap or is expensive? The general market, not the particular firm. The particular firm, you have to compare the intrinsic value you have estimated with the market value of the firm. But then we can have the general market in a bubble or the general market artificially depressed. Okay, we have different measures. These are three of the most used. The price-earning ratio of the whole market, not of your company, but of the whole market, of all the companies in the market. The dividend yield of the whole stock market, not just of one company, but of all of them. And the relation between the stock market, well, I've written PIB, it's in English is GDP, okay. Let's take a look. This is the price-earning ratio of the Standard & Poor's 500 from almost the beginning of the 20th century. Okay, so you see that more or less the average is 15, 16, 17. Okay, and there has been moments where the stock market has been very cheap. In this case, you could be buying the whole market at a price-earning ratio of 10. Here also. And there has been moments in which it has been very expensive. In particular, 2000 and 2001, which was the moment of the dot-com bubble. Okay? And then you have this peak, which was not very relevant because it was the peak at the beginning of the crisis. So profits were artificially low. And as the stock market has not started to, or has not fallen too much, or as much as the profits, the price-earning ratio was very, very high. But apart from this, you can see moments at which the market is overvalued. Okay? For instance, during the Great Depression, in which overvaluation by historical standards was not so high, but just look at how much the price-earning ratio increased from 10 to almost 20. So at this historical moment, the market did increase quite a lot. Of course, I mean, the Great Depression was a disaster, but it was not because there was a huge stock market bubble. It was a disaster for other reasons. The legend tells us that's because of the stock market bubble. The stock market bubble was one threat of the depression, but if there hasn't been much more things around, it would have been a crisis, another crisis in the history without many repercussions. Okay. Well, here we have the dividend yield of the Standard & Poor's 500. When the dividend yield is very high, it's usually an indication that the market is cheap. Why? Because companies are able to pay huge dividends and those payments are not reflected in the price. Be careful, because when one single company has a huge dividend ratio, normally this means that the company is expensive and that the dividend won't be sustainable. So in some moment in the future the company will cut the dividend. But for the whole market, as it is very difficult that all the companies are paying too much dividends, one company for sure can pay too much dividends or too many dividends, but the whole market is difficult. This can be an indication that the market is cheap. For instance, this peak in the dividend ratio occurred in the year 22 and 23, after the Great Depression, which was one of the best buying opportunities in the history, because the stock market has fallen so much that in the next year it increased at 50%, just in 1 year. Okay. As you can see, the historical average of the dividend ratio is around 4%, but you have to take into account that American companies have changed recently their pattern of behavior. At the beginning of the centuries, it was much common that a company paid regularly a dividend. Nowadays, they prefer to reinvest their profits inside the company. It doesn't matter. The question is that you have to compare the dividend ratio by its historical standards. So, if you look at the recent crisis, you can also see this peak in the dividend ratio, which was after the collapse of the stock market, after Lehman Brothers bankruptcy, which indicated that the market was cheap. Why? Because the dividend ratio was high, so in principle companies were paying a level of dividends much higher than the price. And finally we have another measure, which is the relative weight of the stock market capitalization, the stock market value over GDP. There is no direct relation between GDP and market valuation, but there exists a historical regularity. Okay, and that regularity indicates that when the market value of all the stock market is higher than 90% of the GDP, the stock market is expensive. And when you can buy the stock market at less than 50% of GDP, the stock market is cheap. In between, it's not neither expensive nor cheap. You can look at specific companies for obtaining bargain prices. But in general, as I said, the maximum and the minimum limit are these. If you are able to buy in a moment, in a situation in which the general stock market is below 50%, almost for sure the general market will grow in the future. If you buy when the general stock market has a weight of more than 90% of GDP, with high probability the stock market will fall, and even if you have chosen a good investment, in the short or medium term your stock may fall because of the correction in the general market. Okay? This is the ratio Warren Buffett values more highly, the macro ratio. Warren Buffett is more a micro guy. He's not very interested in macroeconomics and in macro ratios, but this stock market GDP ratio, he follows it quite a lot. Well, with this, I want to finish the stock market valuation, but before ending the lesson, I want you to give some comments on some alternative investments, not just stock market, but also real estate, commodities and currencies. Okay? Which are some kind of investments which some of them has some things in common with the cycle. First of all, if you want to invest in real estate, you can also do the same valuation or employ the same or very similar tools that the ones we have developed for the stock market. In the housing market, there exists also a price-earning ratio, and you should try to calculate the price-earning ratio of the house you are willing to purchase. How is defined the price-earning ratio in the case of the stock market, of the housing market? as the ratio between the price of the house and the annual rent you could obtain for that house. So imagine you can buy a building for 200,000 euros and you can rent that building for 10,000 euros per year. The price earning ratio of this building would be 20, as in the stock market. Okay? So, as investors are moving capital among all markets, what won't happen for many years is that some kind of assets have a very high price earning ratio and other kind of assets have a very low price earning ratio. Why? Because if the price earning ratio of the real estate is 20 or 30, what will happen, and the price earning ratio of the stock market is 10, what will happen is that investors will take capital from the real estate market and put capital into the stock market. So you can expect in that case that the prices of the stock market will fall. Of the real estate market. Here we have the price earning ratio of the housing market of Spain. And you can see that the historical average in Spain has been around 19, because Spanish people prefer to have a home than a stock portfolio. They value psychologically more having a house, okay? So they are willing to pay a higher price earning ratio for a house than for a portfolio. But apart from that, obviously it made no sense to pay 33 times the annual renting of a house when buying it in property. And that was the situation in 2007. So it was clear that we had a bubble in the housing market. And as we can see, the price earning ratio has started to correct. The same happened at the beginning of the 90s. Here you had a clear market opportunity because the price earning ratio was below historical average. So you can employ exactly the same tools for valuing the real estate market as for valuing the stock market. It's the same. Commodities. Just some comments in order to... I'm not saying you shouldn't invest in commodities, it's completely up to you, but you have to take into account some risks that are not present in other kind of investments. The demand for commodities tend to be very inelastic. What means to be very inelastic? That even if the price of commodities increases a lot, the demand does not fall. Or, seeing it from another perspective, price has to increase a lot in order to restrict demand. This is, if oil prices increases 10%, almost the same people that was buying oil when it was 10% cheaper still wants to buy oil. So if we have not enough oil for everyone, the prices of oil, in order to block that people from buying oil, have to increase a lot. Not 10%, but 100 more, 70, 80%. Okay? And on the contrary, if the available supply increases a little bit, prices fall a lot. Okay? So, the problem of investing in commodities is first that the volatility can be huge. because what is deciding whether the price goes up or goes down is not the whole market, but as in every other product, is the marginal buyer or the marginal seller. And as the prices are as demand is very inelastic, a tiny increase in supply can reduce a lot prices, and a tiny decrease in supply can increase a lot prices. So you can see the evolution of oil prices that in 2008 go to $150 per barrel, and in 2009 it was at $30. Why? Because the demand has changed just a little bit. Okay? So if you have some extra supply, prices go down a lot. If you have some lack of supply, prices go up a lot. So take into account that volatility. Then, precisely because of that, the price of commodities is governed by the marginal producer, by the marginal cost of the marginal producer. So if new technologies appear which reduce the marginal cost of commodities, prices go down a lot. And that's another risk you may have to consider. The possibility that new technologies or new suppliers at a lower cost, new substitutes for your commodity at a lower cost appear. And finally, the last risk is that in commodities you have no moat or almost no competitive advantage. Commodity is the most basic good, so the only competitive advantage you can have is economies of scale, the only. And if you have commodities of scale in the production, that's okay. But even if you have commodities of scale, your possibilities of increasing your profits depend completely on demand, and not on the value you create for the demand. I mean, you can be the largest company in the world producing copper, but as you cannot add any value to copper, if the demand of copper goes down for any other reason, your price will go down. Even if you have economies of scale, even if you have some governmental license that restricts competition in copper sector, it doesn't matter, and your profits will go down. So the volatility in the commodity market tends to be quite high, so you have to understand very well the real situation of the market in order to invest. I'm not saying you shouldn't invest. Personally, part of or one of the best investments I've done have been in commodities, but you have to be careful because the movements of prices are very drastic. And finally, just for ending, currencies and gold. Okay, currencies have no intrinsic value. You cannot compute any fundamental value for the currencies. The currencies don't produce any future income. In the case of commodities, they do produce. It's the price at which you sell the commodities in order to create value to the consumers. So the future value of the commodities depends on the utility of those commodities for the consumer. In the case of currencies, you cannot have that calculation. Any value of the currency is good enough in order for the currency to be a good currency. Okay? If you have a 100 increase or a 100 decrease in the value of the currency, so you have a 100% inflation, if up to that point, if beyond that point the value of the currency becomes stable, you can have a good equilibrium in terms of the use of the currency. But the value of the currency have changed a lot. Okay, so any value of the currency is good in order for the currency to develop its functions. The point of a good currency is that its value is stable. But you can have stability at this level, you can have stability at this level, at this level, or at this level. So what's the fundamental value? This, or this? Whatever can be. So don't try to compute a fundamental value because you will fail. I'm not saying you cannot foresee depreciation or appreciations in the currencies. You can if you have good economic theory backing you and you study the movements of central banks, etc. But the appreciation or depreciation of currencies are not something fundamental. It's just trends, and trends that doesn't need to be backed by facts. I mean, even if a central bank is pursuing a very crazy monetary policy, if speculators in the currency market think that the value of the currency is much higher than the current price, the currency will appreciate, even though the policy of the central bank should lead to a depreciation. So be careful with that. In the stock market, that can happen in the short run, but not in the long run. In the long run, speculators cannot modify the fundamental value of the stock. In the currency market, they can. So the same happens with Bitcoin. Bitcoin, you know, that has increased a lot in value in the last years, and especially in the last month. And many people ask if it is a bubble, if it is not a bubble. I say it is not a bubble because what's a bubble? A bubble is the market price is much higher than the intrinsic value. When that happens, you have a bubble because you are overpaying for that asset. But we have said that currencies, including Bitcoin, don't have intrinsic value. So you cannot speak of a bubble. You can think that the price of Bitcoin will fall or will go up, but not because that's a bubble. Okay? Any value of the currency can be a good value for that currency, can be an equilibrium value for that currency. So Bitcoin needs to fall in price because a bubble means that sooner or later the price of the asset will fall. Will necessarily Bitcoin fall in price? No. If more people start to use Bitcoin, in fact it will increase a lot in price. So we cannot speak of a bubble. But this does not mean that the price of Bitcoin cannot fall. Of course the price of Bitcoin can fall. But not because it's a bubble, because the term bubble cannot be used in the market of currencies. Okay? So if you are investing in Bitcoin, you are basically gambling on whether Bitcoin will develop and will continue to develop as money or not. The gamble is that if you think Bitcoin will be a world currency, then it's a good investment because in the future will increase much more in price. If you think it will fail, you shouldn't invest in Bitcoin because the price will go down. But don't expect to calculate a fundamental price of the currency because you cannot know that. Okay? Many economists say that Bitcoin has no intrinsic value, so that its intrinsic value is zero. I think that's obviously a wrong analysis. Currencies don't have intrinsic value as currencies. Okay? They can have intrinsic values as other things. For instance, gold. Gold as currency doesn't have an intrinsic value. Gold has an intrinsic value as commodity. But if you are using a commodity as a currency, the part of the value which depends on its use as currency doesn't have that part intrinsic value. Gold is not worth $2,000 because of its value as commodity. If gold were used just as commodity, its price would be, I don't know, $50, $100. All the rest, it's the value of the currency. And the value of the currency does not have intrinsic value, because its value is just dependent on how many people use it. So it's not final utility. It's just intermediate utility, if you want. Okay? So that happens with Bitcoin, and very similar in the case of gold. If you want to invest in gold, go ahead. It can be a very good investment, but investing in gold means gambling that the current fiat monetary system will fall apart, and so that alternative currencies will emerge, and that the people will put its savings into gold. That can happen. I don't say it's impossible. I think in the short run or the medium run we won't see it, but it can happen. If you think that's a macroeconomic scenario, you should invest in gold. And anyway, even if you don't see that scenario, gold is a sensible investment for people with with relatively large portfolios of assets. Why? Because gold is like an insurance against everything. If we have a world war, the price of gold will go up. If we have massive earthquake or a meteorite that impacts on the earth, the price of gold will go up. If the current monetary system would fall apart, the price of gold will go up. So investing gold makes sense if you are rich and you want to have an insurance against apocalypse. And it makes sense to have that kind of insurance because you cannot foresee completely the future. So it makes no sense to say, I'm a very rich person, but all my welfare depends on the current situation to continue. But if the current situation changes, I can starve. I cannot feed myself. It makes sense to part of your portfolio, a tiny part, maybe a 5%, 6%, not 100%. But a portion of your portfolio to be invested in gold in case something very strange happens, you lose all your portfolio, but you will still have gold with which you could engage in some transactions. When there's a war between countries, paper currencies are not worth anything in international trade. I mean, imagine a war against Europe and the United States. Do you think that Europe would accept the dollars as an exchange? No. And the United States won't accept euros as a means of payment. So if you are living in Europe and you want to buy something in the United States, you have to pay in an objective and international currency. Which one? Gold. Not dollars, not euros. Okay? Because you are not having dollars and you cannot pay in euros, and vice versa. Okay? So this is all just some bibliography if you want to study these topics in with more calm, with more references, with more comments, with more analysis. You can find many books, but this is, I think, a good selection of some of the most important you should read. The Intelligent Investor is one of the best in order to start, although it is a bit old-fashioned, but is the one with which many value investors have started. The Intelligent Investor of Benjamin Graham. Then you have Security Analysis of Benjamin Graham, which is the serious treatise. The Intelligent Investor is the divulgative book. The Security Analysis is the magnum opus of Graham. Then you have another book which is very, very good in order to start, which is The Little Book That Beats the Market of Joel Greenblatt. Other book also very interesting for starters is The Dando Investor, the Monish Pabrai, by Monish Pabrai. And then if you want to make some advanced reading, you can go for Bruce Greenwald. Bruce Greenwald is professor at Columbia University in the United States, and he's one of the most renowned theoreticians in value investing, with his book Value Investing from Graham to Buffett and Beyond. You should also read the book The Quest for Value by John Bennett Stewart III, which is the book which develops the concept of economic value added that I have tried to explain to you today. And also two books inspiring. One is Super Stocks by Kenneth Fisher, where it's explained the concept of price to sales ratio, and the book of You Can Also Be a Stock Market Genius by Joel Greenblatt, where you can find specific business opportunities, specific investing opportunities, which are normally not studied carefully by professional investors. So it's usual you can find good investing opportunities in some situations. For instance, when two companies merge, it's not usually well estimated the fair value of that company. When you have a spin-off, this is the separation of one company from another, the spin-off company is usually not well, the value is not estimated correctly, etc. So you can have some kind of situations in which is very interesting to look at in case you can find some investing opportunities.